Look at the financial headlines today, and you'll see a number being presented as a significant victory. The US unemployment rate just dropped from 4.3% down to 4.2%. This headline suggests a rock-solid economy, but the internal numbers tell a different story. In June, the US labor market hit a major speed bump. This chart tracks recent US job creation, and the June data serves as a wake-up call. The US economy added a mere 57,000 jobs last month. To put that in perspective, economists were expecting at least 100,000 jobs. That represents a sharp loss of momentum from the 129,000 jobs gained in May. Some analysts point to the first-half average of 92,000 jobs per month as proof of resilience, especially compared to last year's average of 10,000. But a drop this sudden suggests the economic engine is rapidly stalling. Investors who focus only on the headline rate are overlooking an economy that is cooling at an accelerated pace. How does the unemployment rate actually stall when job creation is drying up? The answer lies in the labor force participation rate, a metric that provides the context the headline rate often misses. This graph tracks the percentage of working-age Americans actively engaged in the economy. In June, that participation rate plunged to a 5-year low of 61.5%. The leisure and hospitality sector serves as an index of consumer health because it is tied directly to discretionary spending, the fun money in a household budget. In June, businesses in this sector shed a staggering 61,000 jobs. Even major seasonal events, like international soccer tournaments, failed to bolster hiring. The Bureau of Labor Statistics noted that seasonal hiring across the board was much weaker than historical norms. This trend continued in retail trade, which lost 7,500 jobs, and the information sector dropped 9,000. Industries reliant on consumer confidence are clearly pulling back. The primary sectors keeping the numbers positive were healthcare and private education, which added a combined 69,000 jobs. Healthcare hiring is a structural necessity for an aging U.S. population. It represents defensive hiring, which functions differently than the talent acquisition seen during periods of broad economic expansion. When the only sector carrying the economy is the one we need because we are getting older, it indicates that the engines of the private market are stalling. This slowdown is occurring alongside 3 major headwinds: an aging demographic, the rapid adoption of AI, and a recent spike in oil prices. The adoption of artificial intelligence is altering the labor market's foundation by automating roles that previously required human capital. Rising oil prices further complicate the outlook by increasing overhead and reducing hiring confidence for logistics-dependent businesses. These energy costs stemming from instability in the Middle East create structural pressures that force businesses to rethink their long-term growth strategies. We are seeing a scenario where the official unemployment rate is falling at the same time the workforce is actively shrinking. As an investor, you cannot afford to buy into surface-level noise. Keep your eyes on the participation rate, protect your capital, and look past the statistical illusion of growth. This is brick money. Make your moves wisely.